Hello, everybody, and thank you very much for joining this webinar today on knowledge graphs for concept-based investing. In terms of the format today, the webinar is being recorded, but please feel free to send questions at any time using the chat functionality, and you can also use the Q&A at the end. I'm delighted to be here today to talk to Tony, who's going to share some research that he's conducted. But before we start, a little bit of background. Tony's a portfolio manager and executive director at RAM, Active Investments in Geneva, Switzerland. He works together with RAM's team of equity portfolio managers to develop systematic investment strategies. Tony's work is focused primarily on extracting market inefficiencies from different sources, from traditional fundamentals, market signals, alternative data, and machine learning. And his expertise is in mid to low frequency in equities. Tony started his career at Unigestion in 2006, where he joined the qualitative equity low volatility team to work as a research analyst. He evolved into a member of the Research and Investment Committee for Minimum Variance Strategies, where he led the Factor Investing Research Group for institutional clients. In 2015, he moved to EdTech Risk Scientific Beta as a senior consultant for risk allocation and factor strategies before going to a major UK pension fund in 2016 to build the in-house systematic equity, co-managing 6 billion GBP as a senior quantitative portfolio manager. And he joined RAM Active Investments in January 2019. Tony holds a bachelor and master's degree in econometry and finance from the University of Savoy in France. He's editor-in-chief for the Journal of Machine Learning and Finance, and he's chair of the EMEA Machine Byte think tank. So first of all, Tony, I'm delighted to welcome you here today. Thank you very much for joining us.
Thanks for having me. I'm very glad to be here, and I'm just thinking that I have to shorten a little bit my bio.
No, it's great. It's a very, very impressive list of achievements. Now, before we kind of get into the depths of the conversation here, could you maybe give us a bit of context and tell us a little bit about how you first heard about Yewno's AI technology and how you decided that you wanted to use it for your research?
Well, that's a fun story. Actually, the first time I heard about you guys were during the Alternative Data conference. I'm a quantitative portfolio manager and quantitative researcher. So decent part of my job is to scout or at least to be aware of what is out there in terms of potential source of new alpha. And I heard about you at the first time, and I heard about you the second time through a different industry because I was digging into one of my latest obsession, which is graph knowledge.
So in terms of the Yewno data that you tested, I believe you were testing the Yewno concept exposure news data with a 2-day window. I don't want to give everyone the full view of this entire webinar, but could you give us a high-level overview of your research and your findings?
Sure. So the idea for me as a quantitative portfolio manager within an hedge fund is always to find potential new source of innovation in order to avoid crowding, in order to simply innovate. So for me, being capable in my job to onboard as much and as many possible new source of data is paramount, but it's not without any challenges. So this is what I had in mind when I heard about the data you provided, in order to have a goal on 2 aspects. First, the first layer for me was being capable of assessing the added value of a standalone concept, and because as you know, the concept is an approximation of a beta exposure to something that could be alpha semantic. For instance, it could be the name of a person, it could be a location, it could be anything, it could be just a number. And this idea to go slightly beyond the orthodoxy of traditional and alternative source of data nowadays has seduced me in order to test it as a standalone potential factors or signals, if people prefer, and amongst all the pipeline of machine learning models that I'm using in my research and in my.
Thank you. So in terms of how a quant manager would turn our concept exposure data into actionable insights for investing in their models, could you tell us a little bit about that?
Yeah, so the first challenge, and this is an exercise that potentially modern quants are facing many times a year, is how to onboard a new data set. This is not a trivial exercise because it's come with a lot of challenges. Some of the challenges I'm gonna address them here with these slides. Actually, the first challenge were to select concepts. Why? Because you have millions of them. You know, data is very broad in terms of concept-wise. So potentially there are millions of new signals to be tested. After that, amongst all the data that you provided, you provide different flavor of scores. I'm going to address that. So the number of scores are adding importance. How to deal also with the data history is very important because when you have 5 years or 6 years of data, it will be too short to test signals on a monthly pace, which is traditionally what people tend to do in mid-term to long-term equity. Another important aspect is the coverage of it, because obviously I wanted to have a quick idea of the most challenging sub-part of the equity market, which is the liquid US stocks part. And finally, those data, in order to have an idea of their potential added value, you have to calibrate it towards a prediction horizon. Is it going to be very important for short-term prediction, for short-term stocks, for long-term portfolio, long-term portfolio? And that was all the points that I wanted to address in my study. Operationally speaking, nowadays, alternative data providers have been extremely helpful providing API, which you did. And using the API, has been exactly the same path for other competitors of yours, using Python mainly in order to download CSV file. As you see here in the presentation, in order to make it real for people, this is how I did it in order to put it through an SQL database. And basically, since I have this idea of testing different flavor of scores that you are providing, I split these new signals, a new data set of signals, through the concepts multiplied by 3, which are the 3 level of score that you are providing. Even if you are providing slightly more than that, I just use the aggregate, the similarity, and the centrality scores. I left the part of the contribution of the per play. And basically, I created signals, just like any quant, which is very familiar, and I test them all, which gives you this idea in terms of minimum date, maximum date, number of occurrences, the coverage of the stock. So it deliberately selected concepts that were supposedly less covered in order to see if it has an impact, which is something that I do in my job for other data sets as well.
Fantastic, thank you. And in terms of generating alpha, why do you think machine learning is becoming more important in this respect?
Yeah, exactly, that's a very good question. One of the challenges that you will face by using this almost infinite number of concepts, which is, we are talking about million, is an operational one. It's almost impossible if you don't have the framework, the structure, to test them all with traditional methodology. One of the things that machine learning is very helpful, on top of all the points that I'm going to explain that you are seeing at the moment in the slides, it's an operational point, which is very obvious with machine learning, is you can test more. Those models will be thriving through hyperdimension. In some cases, the higher the better. And in order to bridge this technological challenges of having millions of concepts, one always has to bear some point in mind about what to expect from machine learning. I listed some of the points here, and you'll see that using machine learning in order to test a very broad database as a concept-based one is very helpful. The first point is to test more characteristics. It's very obvious, I just explained it. The second thing that somebody is expecting from a machine learning model is to leverage on the nonlinearities of the model which is used. In our case, we're going to use a plain vanilla boosted tree models in order to have all the flexibility of nonlinearities and basing our approach on the model that are running also in my daily job. The third part is to adapt and identify by rerunning the models in order to have this rolling window. And that's extremely helpful, also blended with this graph knowledge database, because in graph knowledge data structure, you have emerging concepts, things that were not in the past, and that you want to slightly be exposed to within your portfolio. The last point is obviously to broad everything together. Most of the time in machine learning model and also in concept-based investing, you're gonna have to blend different models together in order to have a better mix. And basically the last point is something which is also true for knowledge-based data, is to be less biased. As I was saying, the idea of knowledge graph is also to have emerging new concepts. So to be less biased by new things that you have small window in order to analyze.
Thank you. And in terms of the research overall, could you tell us a little bit about what your most surprising finding was in terms of your research?
Yeah, well, I had some very surprising but good in a positive way results. By the way, you will receive the presentation that I'm slowly sliding here. We're gonna dig into more some of the part in the part 2 that will be soon, because this webinar will have 2 parts, and you will have all the flexibility of reviewing in it. So here, yeah, this part is a really fun one, because I wanted to analyze the concept idea as a standalone signal. So I'm not saying it's a factors in a risk premias academical point of view. I'm just here on an empirical heuristic standpoint testing things, which is exactly the situation you're going to face if you're interested in those data. So basically, I had a very interesting example, which is a partnership. Right? So what you're seeing here is the cumulative performance of portfolio based on the exposure of this concept through these scores. Okay, so all the lines that you are seeing is cumulative performance ranked in decile, which is very common in quantitative research when you try to see if there is a monotonicity. And here, in this example, in this exercise of testing standalone concept ID, I found very good example of concept, which in the first place, I cherry-picked them using very simple fundamental concepts such as dividend, partnership, fraud, and things like that, very generic topics. And I found when you dig into the data that there is a strong connection also on the economical and financial standpoint. So you see that here, partnership, highly exposed company to partnership tends to outperform the rest of the market. When you dig into the related stocks which are in this portfolio, which is the D10, the higher decile, you'll see really big names such as Amazon, Walmart. So if you go into the connecting the dots on a financial and economical standpoint, you have those good results. And I have to show you another one, which has been found by using this time machine learning, which is almost funny. So here I'm going slightly into the detail, but when you use machine learning in this very high hyperplane data set with so many concepts, the idea, the first run of your model is not really to go to find a new source of alpha. You are really prospecting a little bit the data. So one good approximation on top of checking the accuracy of your machine learning model, obviously, is to check afterwards the feature importance, right? Imagine you have a new data set, you know nothing about those signals. You want to see if they are important compared to different horizon in terms of prediction. So you're going to see if those concepts will have an importance for shorter term strategies, for mid-term or longer term. And here I get a very good example, which amongst the list of the 30 concepts that I've selected, one of them proved to be very important for the performance of short term, which is 1 week here, which is return over 1 week. And that's securities fraud. And that's very funny, because when you see that, when you try to predict this time longer horizons, such as slightly longer, like 1 month, right, this importance of securities fraud over the short term of stock prices for US liquid stocks is lower, right? And what is happening is that what you expect, which are the fundamental parts of those companies, is kicking out, right? So you see that over slightly longer term, which is 1 month, a concept such as assets or concepts such as earnings are more important than short-term move such as securities fraud. And that's exactly what I'm expecting from this very innovative, broad concept-based database. That's what I want to see. New things that are not expected, but that could be explained afterwards.
Thank you for that. That's great. So one of the things you mentioned earlier was the number of concepts and obviously the sheer scale of this data set. Could you break down your process for onboarding the Yewno data and a little bit about your methodology?
Sure. Regarding concepts, this is a challenge that I explain here in one of the first slides. How our selected concepts, basically using generic topics for stocks. So nowadays, people are much more, let's say, NLP/sentiment signal friendly. For the most innovative ones, they are running the proprietary NLP model. For the other ones, they could use third-party sources. But amongst those in-house or third-party database, there is a lot of common concepts such as topic, so in NLP, which are proved to be very helpful, the one related to fundamentals, the one related to frauds and things like that. So I basically used my own domain knowledge in order to use very generic topics. And that has been my way of doing it. But there are so many ways of like an elastic search, like doing playing a little bit with the other parameters of the graphs, using the ontology or the taxonomy, which are regular ways of assessing concepts through a knowledge graph. Could be ways, could be avenues interesting for concept selection in the first steps.
Great. And in terms of your experience, could you talk a little bit about how the Yewno data is differentiated from some of the other data sets that you've seen in the industry?
Yeah, the thing that I do like, and that's why graph knowledge is part of my triptych of obsession in modeling, which are genetic algorithm, machine learning, and graph knowledge. What I do really like about graph knowledge, which is going to explain why I think it's slightly different for the other one, it's the ambition which is different behind it. And that's why I put the first slide here. It's about knowledge. The idea and what is really extremely important behind the graph knowledge, how it's built, and how can you harvest it, is the layer, the perimeter of the layers. How can you put level in concepts, in ideas, which is to some extent an abstraction of how the human brains and an attempt to modeling some kind of human consciousness. And that's something which is different, which is why I'm saying that the ambition behind those type of data is very different from plain vanilla, very effective still, NLP techniques, internal or external.
Fantastic. So in terms of questions, I'm seeing questions coming in the QA now. So I'd like to move on to audience questions, if I may, and I'll read them out so that everybody in the audience can see what we're talking about. So the first one is says, "Thank you, Tony, very interesting. The feature importance looks good, but what is the accuracy of the predictive model from which you extract the feature importance, which is using the Yewno data to predict portfolio returns?" And then in brackets, yeah. I assume.
Sure, that's a very good question. It's going to be in the part 2, and I'm going to reveal the number. It's a classification model. So basically, the error is going to be easier to give. It's around 55% of accuracy in a classification model. Just to give you an order of comparison, I do other research in machine learning, and in most of our papers with the people I'm writing, we disclose accuracy level. This is very comparable to what we've got in other research and also in live modeling. If somebody is telling you that its accuracy is about 80% in machine learning for finance, it might be overfit.
Fantastic. And another one. So again, this person says, thank you very much for an awesome idea. Can you elaborate in the knowledge graph? What are the vertices and what are the edges?
Well, that will be to you to answer from the Yewno guy. But in order to give you some illustration, I think here is going to be that's the one slide. So the thing that, and Ruth is going to be to you to comment. Maybe you're going to disagree. The thing that I found very smart in the way you structure and structure data is to treat the entity as a requested concept. So here in this idea, you'll see that all the entity will be forced to be listed companies, which restrict the parameters. On top of that, I selected concepts that are topics based, that are labeled. Right? I'm not using edges which are extremely subtle in things, because basically when you're downloading those APR, this is where, I mean, on my test, you don't have access to modification of the graph. But Ruth, this is up to you to complement on that.
Yeah, so I think, going back a little bit to what you said earlier, philosophically, what the knowledge graph is trying to do is to recreate a neural network model to do what a human brain could do, but on an exponential AI-based scale. And in terms of concepts, a concept is not just a word. It is an idea, an expression. It could be a company, it could be a person, it could be a geographic place, it could be a term. And I think going back to kind of this concept universe, that's the richness of the data, is the breadth, but you need to know how to use it. And I think, Tony was just talking a little bit about entities there. We are actually introducing, Tony, you'll be pleased to hear, a new feature on concepts, which is concept categories. So you'll be able to do your request either by entity or by person or by place or other, or any combination of those. So you could say, I want places and people, or entities and people, or whatever. So we are bringing in a bit more filtering there, and I think that will also be a useful feature. Another question, actually they're all pinging in now, so I'll work my way through. So the first one is, I believe you used dividend as a concept in one of your slides. If you wanted high exposure to dividend, why not take the dividend yield? What is the difference between high exposure to a dividend concept and high dividend yield? And how do you interpret that exposure?
That's a great question. Again, this is a statement that I might regret at some point. But the thing that I do like, and what I do believe, is that at some point, the news about the release of an earnings or the release of a dividend could have a slightly complementary, potentially, or augmented impact at just the plain vanilla level of dividend. But that's a very good point, and I'm going to compare the results of, because obviously I do use also signals such as trailing dividend yield or estimating dividend yield. But again, for those that are using NLP topics-based signals, they will be very familiar with the fact that, for instance, earning released, treated as a news through an NLP sentiment, is having slightly more octane in terms of out of sample performance results than just plain vanilla revision scores that have been slightly more commoditized in the way they've treated or absorbed or used in asset management and in hedge funds. So I will say that intuitively, and this is what I saw comparing concept versus NLP/topic, which are dividend, this is the perfect case, or earnings or assets, those things you can do it. But it seems that at some point, those text-based type of signals having better results than plain vanilla estimates or plain vanilla trailings that you're going to use. I'm not saying that they are obsolete. This is not true. And there is still value in estimates as it has been used for the 20 years. But I'm just saying that this is the only way towards the future. And that's the thing. Everything now it's text-based. The coverage is better. You could have faster opinion. You can use a lot of subtleties using those fundamentals, metrics coming from text-based data.
Thank you. Moving on to the next question. So This one says, I noted you labeled the features with KG_C_earnings or KG_S_earnings, KG_A_earnings, etc. What does C, A, and S stand for here? And are these different concepts in the graph?
So you'll see here, and that's again the perfect slide. So A, S, C are different scores provided by Yewno. I'm not going to explain them in front of the co-founder. I'm not going to do this. But what I'm going to say, why I only selected 3. So you see that basically there are 5. This is the aggregate, which is a weighted sum of all of them, the similarity, centrality, contribution, and pure play. I flipped the problem on the other side, just like a pragmatic quant that I am. I checked the coverage. The coverage is better on obviously the similarity, the centrality, and the aggregate, for good reason, which I'm letting the people from Yewno comment. And that's what they stand from. What I wanted to see is to split between those 3 different scores, which do have this is important to split them because you can have very different results. I'm going to just illustrate that and pass to Ruth afterwards. So you see that here, this is just an empirical example. I wanted to see the difference by concentration, aggregation, or similarities. And you see, most of the time you see interesting relief, you see interesting things behind it. So there is for me, there is an interest of splitting them.
Yeah, so thank you very much for the question, and also Tony for the answer. So there are a range, obviously, there are a range of different features within these content sets. So there's all of the different types, and in this call, we've really just been talking about news. There's also all of the different time periods or windows, and then there's also all of the different factors. And I actually, you probably all noticed that you were invited today to Knowledge Graph for Concept-Based Investing Part 1. We're actually going to be sharing some more results in Part 2. So I'm not going to steal Tony's thunder in terms of what we're going to cover in the next call. I'm just seeing more questions. I'm going to try and get as many as we can in, but if you keep sending questions and we don't get to answer them, don't worry, because we will download them and we'll write back to you afterwards. But this is another question in the same direction. So it is, I wonder how the concepts are defined or collected. Are they generated through topic modeling or through human inputs? How do you detect or select which concepts are useful to your task? Is KG able to provide an interpretability in this direction? Tony, shall I answer the first bit in terms of the Yewno technology, and then I'll leave you to talk a little bit about you. Yeah.
Please do. I was about to say it.
Yeah. No, really, really interesting question. So I think at the beginning of any kind of AI-based or machine learning model, you do a training phase. So when you start your training, you are feeding your machine or your model with a certain definition or set of terms. And when you understand that it is interpreting those terms in the text correctly, you will expand and expand. And in our case, what we were looking to do was to recreate this neural network model where the technology can actually understand the text, not just hunt for keywords, and it can also identify new concepts without being fed those specific terms. And that's the key thing, because if you think about the amount of data, the volume of data that exists, that is created every day, every second, you need a machine learning tool that will do that without human supervision. So in terms of your question, are there human inputs? There are human inputs at the very beginning. There's always QA, but other than that, it is machine learning driven. And that's the only way any of us could actually deal with the volume of data. You know, Tony shared an absolute ton of information today, but he's only been looking at news. So can you imagine what's going to happen next week when he's worked his way through 5 other data sets? No, I'm only kidding. We're not going to cover them all next week, but you know, you see where I'm going with this. So I think that's the key thing about AI and machine learning in the context of sort of where we are today. But in terms of this second part of the question, how you select which concepts are useful to your task, Tony, let me pass that one back to you.
Sure, but again, I said it slightly in different words earlier. In finance, if you did already some exercise doing topic extraction with the financial taxonomy, you'll find 50, 100 different topics of concepts, which are linked to these fundamental metrics. Most of the time, there is a lot of correlation with the signals you can use on the balance sheet fundamental side and the topics which are based with the most important topics. It depends obviously on the sector you're dealing, but globally speaking, this is how I do it. And on top of that, since this is just at this level That's why I do like this huge database of concepts. On the safe side, we know that using domain knowledge, financial domain knowledge, is a safe, sound way of accompanying this effort of machine data crunching.
Fantastic. Thanks, Tony. So we have finished the questions in the chat and we're almost up on time. If you would mind sharing the final slide, I'll just talk to people about next steps. So in terms of what's going to happen after the call, we will be sending everybody a copy of the presentation. So don't worry about whether or not you took good notes. You'll get a copy of the slides and you will also get a copy of the recording. There is a part 2, which is the same time next Tuesday. We'll be going into more depth. And if you do have any further questions in the meantime, please feel free to email in at any point, either to Fabio or Alex. And we will also liaise with Tony if we need to, in terms of getting to the depths of his research.
Pleasure.
So I'd like to say thank you very, very much, Tony, for joining us here this morning. It's been great and looking forward to talking to you again next week.
Pleasure. Bye-bye. Thank you.
Everybody. Thanks for joining us.